All right, welcome to today's Explainer. We're diving straight into a hyper-analytical daily strategy report from July 16th, 2026. This isn't your standard run-of-the-mill market recap. We're dissecting exactly how Tier 1 institutional banks are quietly repositioning their capital based on some seriously strict macro data. If you want to figure out where the smart money is hiding and how they're viewing global asset pricing right now, you are absolutely in the right place. We've got a packed agenda today, so we're going to move step by step. We'll start with the economy's dual identity, then dive into evaporating systemic liquidity, big tech's dot-com parallel, the great institutional capital shift, two specific survival scenarios, and wrap it all up with a final verdict and insight. Let's get right into it. Starting right off with Section 1, the economy's dual identity. On the surface, retail investors are looking at headline inflation and celebrating. Headline CPI dropped 0.4%, heavily driven by plummeting gas and energy prices. It looks like a win, right? But wait, when you peel back the layers and strip away food and energy, the reality is that core PPI actually rose by 0.2%. Underlying inflation is incredibly sticky. It is a classic good is bad dynamic, honestly feeling a lot like the stagflation we saw in the 1970s. And that's exactly why the market is scrambling to reprice the odds of a September rate hike to somewhere near 44 to 49%. And Fed Chair Kevin Warsh is absolutely killing any lingering hopes of a premature rate cut. He's talking about how the Fed has entered a hawkish plateau. He's demanding a blank slate approach with zero compromise on that 2% target. He even pointed out that this massive infrastructure build-out for AI could actually drive prices up in the short term. So make no mistake, the Fed is not signaling the end of tightening. They're preparing to keep rates structurally high to fend off any inflation reacceleration. Which brings us right into Section 2, evaporating systemic liquidity. When you move past the headlines and look at the invisible plumbing of the global financial system, there's a terrifying warning sign flashing. Basically, our financial engine is completely running out of oil. The Fed's reverse repo facility, the RRP, which is essentially the core buffer for excess cash, is totally depleted. It's sitting at just $125 million, which is virtually zero in this context. At the exact same time, the Treasury General account is rapidly expanding, looking to suck up an astonishing $1 trillion by the end of July. Institutions literally call this a liquidity vacuum. We have this simultaneous drain where the RRP is empty and the expanding TGA is violently sucking excess liquidity right out of the market. It heavily mirrors the repo market collateral shortages we saw right before the 2008 financial crisis. With that cash buffer completely gone, the massive amount of new bills the Treasury is issuing will pull cash directly out of bank reserves. That is the exact mechanism that forces violent deleveraging. So, how does this affect equities? Let's hit Section 3, big tech's.com parallel. This liquidity drain is exposing some extreme fragility right at the top of the index. You know the Magnificent Seven, right? Well, this tiny handful of tech giants is holding up the entire market. They account for 29% of the S&P 500's market cap and 28% of its earnings. That is some serious concentration risk. It's not a healthy, broad-based rally, it's a precarious balancing act that makes the whole structure incredibly vulnerable. And honestly, the parallels to the 2000 dot-com bubble are wild right now. Take TSMC, for example. They just announced a massive 77% jump in net profit and record-breaking 2026 AI capital expenditures of $60 to $64 billion. But what happened? The stock actually dropped 2 to 4%. The market is remembering the telecom infrastructure boom of the year 2000. Massive spending without immediate free cash flow is now being punished as a massive margin squeeze. The narrative is violently shifting from growth at all costs to show me the actual return on investment. And beneath the surface, things are highly unstable. The VIX just surged nearly 7% to 1673. We're seeing record highs in 0 days to expiration options trading. Those are hyper short-term same-day bets, and they're creating extreme vulnerability for a gamma squeeze. It's like a ticking time bomb for tech stocks. We literally just saw this play out when South Korea abruptly halted listings for leveraged single-stock ETFs on Samsung, which forced a violent unwind and a massive intraday drop in the global semiconductor index. Okay, Section 4, the Great Institutional Capital Shift. So knowing all of this, what is the smart money actually doing to survive? Well, they are aggressively dumping long-duration tech assets that don't have an immediate payoff. Instead, they're pouring capital into defensive, cash-generating sectors. We saw United Health Group surge 7.5% because they proved they can control costs. Large banks like Goldman and JP Morgan are thriving on trading fees, and utilities are winning. Meanwhile, IBM crashed 19% pre-market due to software struggles and massive hardware spending. It's a textbook risk parity rotation out of unproven AI infrastructure and into resilient value. Even the traditional safe havens are getting crushed. Gold just temporarily broke below the critical $4,000 mark, hitting around $3,977. Bitcoin has completely stalled out too. Why? Because the real yield on 10-year Treasury inflation-protected securities, TIPS, is staying over 2%. When a risk-free asset yields that much above inflation, the opportunity cost of holding something that doesn't pay a yield, like gold or crypto, triggers a massive liquidity drain. Now let's look at Section 5, 2 survival scenarios. Right now, Wall Street is completely divided. You've got Morgan Stanley projecting endless momentum, targeting an S&P of 8,400 or more based on this unshakable faith in earnings. But on the other hand, Goldman Sachs is issuing a very strict warning. They're targeting 8,000, warning of a flat multiple with absolute zero upside. And the strict macro data, it heavily supports Goldman's conservative take. You simply cannot blindly trust momentum when system liquidity is drying up and AI software adoption is getting severely delayed. So, if we hit scenario B, a true liquidity shock driven by that Treasury account expansion, here is your exact step-by-step action plan. Watch for the 10-year yield to break 4.65% and the VIX to hit 20. If that triggers, you immediately underweight high-duration tech ETFs like XLK and SOXX. Where do you hide? You buy short-term T-bills yielding between 3.8 and 4.1%, and you hold 15% in pure cash. That is exactly how you protect against tail risk. Finally, Section 6, Final Verdict and Insight. Let's bring this all together. The final institutional verdict is brutally clear right now. Bearish on cap-weighted tech indices, it is time to play defense there. But they are incredibly bullish on equal weight and short-duration, cash flow-producing value stocks. We are in the middle of a massive valuation transition phase. Rotate out of the top-heavy index and into undervalued assets. And I want to leave you with the ultimate black swan event that no one is properly pricing in. What happens if, during the upcoming late July earnings calls, AI hyperscalers like Meta, Alphabet, or Microsoft drop even a tiny hint that they are slowing down their 2027 capex, whether it's power grid issues or just hitting a wall on ROI? If that spending slows, the premium valuation holding up this entire tech market will collapse like a house of cards. Think about this chilling insight straight from the institutional trading desks. The clock of earnings and the clock of liquidity tick at entirely different speeds. Even if big tech earnings look flawless today, their current valuations are already pricing in 5 years of perfection. If the underlying liquidity dries up because the reverse repo is empty, those stock prices simply cannot defy gravity. So are you exposing your portfolio to massive duration risk just to follow the herd, or are you building a fortress of actual cash flow? Thanks for joining me for this explainer, and I'll catch you in the next one.